Someone opened a brokerage account this morning with $500 and a YouTube education. By noon, it was $240. By Friday, it was gone. And the worst part, he did everything the internet told him to do. He watched the tutorials. He followed the indicators. He joined the Discord. He even bought the course. The problem was never the tools. The problem was that nobody told him what trading actually is before they told him how to do it. So that's where this starts. Every week, somewhere between 500,000 and 1 million new accounts are opened across global trading platforms. Stocks, Forex, crypto, it doesn't matter which market. The pattern is identical everywhere. Retail participation is at all-time highs. Commission-free apps have made access trivially easy. A teenager in Manila and a retiree in Ohio are now competing in the same market as a Goldman Sachs algorithm running 400,000 trades per second. And nobody thinks that's a problem. Until it is. Here's the honest framing before anything else. Trading is a skill, not a hack, not a side hustle. A skill with a steep learning curve, a measurable failure rate, and a very specific set of prerequisites that almost nobody talks about because prerequisites don't sell courses. 70 to 80% of retail traders lose money. That's not a scare statistic. That's a documented, consistent, cross-market reality. In Forex, some brokers are legally required to disclose it. The number is often higher than 80. So when we talk about how to start trading, we're not talking about how to get rich. We're talking about how to not be the person funding someone else's wealth.
Step 1. Before you open any account, before you download any app, is this. Decide what market you are actually entering and why. Because stocks, Forex, and crypto are not the same thing wearing different clothes. They have different hours, different volatility profiles, different leverage structures, and completely different relationships with macroeconomic events. Stock trading is tied to earnings cycles, sector rotation, and company fundamentals. It's slower moving, generally more regulated, and better suited to people who think in weeks and months rather than minutes. Forex, the foreign exchange market, is the largest financial market on Earth. $6.6 trillion trades through it every single day. It runs 24 hours, 5 days a week across Tokyo, London, and New York sessions. It moves on interest rate decisions, inflation data, geopolitical tension, and central bank language. It rewards discipline and destroys impatience with impressive efficiency. Crypto sits somewhere between a speculative asset class and a technology ecosystem. It trades 24/7, 365. It can move 10% in an afternoon for reasons that make perfect sense in retrospect and no sense in real time. It is the highest risk, highest volatility environment a new trader can enter. Choosing your market first matters because your personality, schedule, and risk tolerance should match the arena. If you have a full-time job, day trading Forex during the London Open at 8 a.m. GMT is not a strategy, it's a fantasy. Step 2 is learning to read price, not indicators, price. Most beginners do it backwards. They load up a chart with 5 indicators, a VWAP line, 2 moving averages, RSI, and MACD, and then they look for the moment all 5 agree. What they've actually done is built a lag machine.
Every single one of those tools is derived from price that already happened. Price action, the raw movement of the market itself, the structure of candles, the way highs and lows form and break. That is the source data. Everything else is commentary. You don't need to master every indicator in existence. You need to understand what price is doing, where it's been, and where the areas of structural significance are. That's support and resistance. That's trend. That's where institutions are likely buying and selling. Everything else you can layer in later once the foundation is solid. Step 3, risk management. And this is where most people leave because it sounds boring compared to entries and setups and big wins. It is not boring. It is the entire game. Here is the math nobody puts in their highlights reel. If you lose 50% of your account, you need to make a 100% just to get back to where you started. Not 50%, a 100. A trader who wins 40% of the time but makes 3 times their risk on winners will, over a large enough sample, beat a trader who wins 60% of the time but only makes half their risk on winners. The win rate that feels good and the win rate that makes money are not the same number. This is why professional traders don't obsess over winning. They obsess over losing small. The rule is simple and almost universally ignored by beginners. Risk no more than 1 to 2% of your total account on any single trade. Not 10%, not half your account because the setup looks perfect. 1 to 2%. On a $1,000 account, that's $10 to $20 per trade. That sounds meaningless. That's the point. At that size, a string of 5 losses doesn't break you. It costs you $50 to $100 and leaves you fully functional to continue. Because the thing trading tests first is not your analysis. It's your emotional stability under financial pressure. And you cannot know what that feels like until real money is on the line.
Here's what the trading content machine will not tell you. Your first 6 months should not be profitable. They probably won't be, and that's not failure. That's calibration. You are paying for education in the most direct way the market offers, which is experience. The goal of the first 6 months is not to make money. It is to lose as little as possible while learning how you personally respond to uncertainty. Paper trading, simulated trading with fake money, helps, but only up to a point. The moment real capital is at risk, psychology enters the room, and the clean, rational decisions you made in simulation become significantly harder to execute. The trading influencer with the Lamborghini in the thumbnail is showing you 6 months of winners. He is not showing you the 4 years of losses before that, or the 10 accounts that went to zero, or the fact that his actual income now comes from selling you the course. The irony is almost elegant. The people who figured out trading don't need to teach it, and the people teaching it most loudly often need the tuition fees to survive. This is not cynicism. It's pattern recognition. Zoom out, and the picture becomes clearer and stranger at the same time. Trading is one of the only professions in the world where you can start with 0 experience and immediately have access to the same instrument as a 30-year veteran with a $100 million fund behind them. The same Bitcoin chart, the same Euro-USD pair, the same Tesla options chain. That accessibility is real, and it is also a trap, because access is not the same as edge. And edge, a statistically demonstrable reason why your approach makes money over time, is what separates trading from expensive gambling. Building that edge takes time. It takes a trading journal. It takes reviewing losses honestly rather than explaining them away. It takes hundreds of trades across different market conditions before any pattern reveals itself as genuinely reliable. Most people are not willing to do that work before risking real money. The market charges them accordingly. So here's the actual answer to the question of how to start trading. Start with the market that fits your life. Learn price before you learn indicators. Manage risk before you think about returns. Trade small until losing feels manageable. Keep records. Do all of that for 6 months before you decide whether this is something you can actually build a skill in, or something you tried once and walked away from, richer in experience and poorer in account balance. Both outcomes teach you something real. The question is just how much you're willing to pay for the lesson. If you find this video helpful, please like it and subscribe to this channel for more videos like this.